Donald Trump doesn't need to buy a single stock to move billions of dollars on Wall Street. Sometimes a few words are enough. In April 2025, US markets were swinging wildly as investors tried to understand the impact of new tariffs. Then Trump posted on social media that it was a great time to buy. Hours later, he announced a pause on many tariffs. The stock market exploded higher. The S&P 500 gained more than 9% in a single day, adding trillions of dollars in market value. And that raises a question. Can a president manipulate the stock market? The answer is more complicated than most people think. When people hear the word manipulation, they usually imagine someone secretly buying stocks and artificially pushing prices higher. That's illegal, but markets move on expectations. And few people on Earth have more power over expectations than the President of the United States. To understand why, you first need to understand what stock prices actually represent. A stock is not just a company, it's a prediction. Every stock price is a giant collective bet about the future. Investors are constantly asking one question: how much money will this company make in the years ahead? Anything that changes that answer can move markets instantly. Interest rates, taxes, government spending, regulations, trade policy. And that's where presidential power enters the picture. Imagine two identical companies. Company A pays a 35% corporate tax rate. Company B pays a 21% corporate tax rate. Which one keeps more profit? The answer is obvious. When Trump signed the Tax Cuts and Jobs Act in 2017, the federal corporate tax rate fell from 35% to 21%. For investors, that wasn't just politics, it was math. Lower taxes meant higher after-tax profits for many companies. Higher expected profits meant higher stock valuations. The market responded accordingly, but taxes are only one lever. Trade policy may be even more powerful. A single tariff announcement can change the expected costs and revenues of thousands of companies overnight. If a tariff increases the cost of imported materials, profit margins can shrink. If a tariff protects domestic producers, some companies may benefit. The challenge is uncertainty. Businesses can adapt to almost any rule. What they struggle with is not knowing what the rules will be next month. And uncertainty is something markets hate. That's why Trump's tariff announcements often triggered immediate market reactions. Investors weren't just pricing the tariffs themselves, they were pricing the uncertainty surrounding them. Sometimes stocks fell sharply, sometimes they surged. The key point is that expectations changed. And when expectations change, prices change. This is where social media adds a new layer to the story. In previous decades, presidents communicated through speeches, press conferences, and official statements. Trump introduced something different: direct communication to millions of people in real time. A post made before markets opened could become the most important financial headline of the day. Algorithms scan headlines automatically. Large trading firms process information in milliseconds. A statement about tariffs, trade negotiations, or economic policy can trigger buying and selling before most investors even finish reading it. The result is a market that reacts faster than ever. But here's the part many people miss. Trump doesn't have to tell investors what to do. He only has to change what they believe will happen. That distinction matters. If investors suddenly expect lower taxes, they buy. If they expect higher tariffs, they sell. If they expect a trade deal, they buy. If they expect a trade war, they sell. The mechanism is surprisingly simple. Change expectations, change prices. And this isn't unique to Trump. Markets moved when Franklin Roosevelt announced major economic programs in the 1930s. They moved when Ronald Reagan pushed tax reforms in the 1980s. They moved when governments launched massive stimulus programs during the 2020 pandemic. Political power has influenced markets for as long as markets have existed. What makes Trump unusual is the speed and unpredictability of the communication. A policy announcement in the past might take days to spread. Today, it can move billions of dollars in seconds. So can Trump manipulate stock prices? If by manipulation you mean directly controlling where stocks go, no. No president controls millions of investors, corporate earnings, interest rates, and global economic forces. But if by manipulation you mean influencing expectations, then every president does it to some degree. The difference is that Trump's communication style often makes that influence more visible. The hidden mechanic beneath the market is this: stock prices are not measuring the present, they're measuring beliefs about the future. And few people can reshape those beliefs more quickly than the President of the United States. Once you understand that, market reactions that seem irrational suddenly make a lot more sense. Because sometimes the biggest force moving money isn't a company's earnings report, it's a sentence. If you enjoy uncovering the hidden mechanics behind money, markets, and power, subscribe to Beneath the Money for more breakdowns like this.